Most traders think this is bullish. Institutions are thinking something completely different. Have you ever been guilty of trying to buy the bottom? I have, and I'm sure most traders have. In this example, we are in a clear downtrend. The price looks like it is bouncing, potentially moving higher. I am using two of the most commonly used indicators in trading. The RSI, which was showing we were oversold, and the EMA, which shows price trading above the line. What could go wrong, right? If you used this line as your entry for the EMA, you have this rejection here, stop loss, and let's say 3 to 1. Let's see what happens. This is the problem with lagging indicators. They tell you what has already happened. They do not tell you what is about to happen. If all retail traders started buying here, do you think they can move the markets? No, of course not. What institutions are actually doing is hunting liquidity. They know exactly where retail traders have their stop losses sitting. Above every bounce, below every low, that is where the liquidity is. And institutions need that liquidity to fill their massive positions. So before they move price higher, they hunt those stop losses first. And that is not random. That is just how big money operates. Now let me show you this exact same chart and what institutions were really doing. This is the same chart, but let me show you exactly what was happening. While retail traders were buying that bounce, institutions were doing something completely different. Look at this fixed range where we have our fixed value area high and we have our fixed POC. So this is where the highest amount of volume was traded within this range, and this is where big money has a lot of resting orders. And you can see when price came back and tapped straight into those levels, retail got flushed out, stopped, and they're done. And right there, institutions added to their positions because that is exactly what they were waiting for. And fixed volume profile shows you exactly where those levels are. Not lagging, not guessing, actual institutional footprints right there on your chart. While retail was buying a fake bounce, volume profile was telling you the whole story. This is the CERC pattern. Consolidation, expansion, retracement, and continuation. This is exactly how institutions build and execute their positions. They consolidate, they take liquidity, price retraces back to their key levels, and then continuation. The best part about this is not a rare setup. These patterns happen every single week across multiple pairs and multiple time frames. Now let me show you a real example. This is our consolidation zone right here. Price expands out of the range, then watch what happens. Price retraces back into our fixed key levels, first from our fixed value area low, then a sharp rejection from our fixed POC. Entry would have been below the candle of that first rejection. And institutions have clearly defended these key levels, and price moves in its intended direction. These CERC patterns happen every single week. Now let me show you the CME pattern. Consolidation, manipulation, expansion. Institutions build their positions in consolidation, then create a false move to grab liquidity. While retail traders get trapped, institutions are filling their orders at better prices. And then, expansion. Price moves aggressively in its intended direction. This setup also appears every single week across multiple pairs and time frames. Let me show you a real example from just last week. First, we have our consolidation zone. Then price breaks down below, and this is just pure manipulation. Price trades below our fixed value area low, taps into it, then pushes down a little further, grabbing liquidity. Then watch what happens. Aggressive push to the upside. Price is now trading above our fixed value area high. Retail traders who are short are now completely trapped. After the rejection from our fixed POC, entry point would be above this range that was formed above the fixed value area high. And look what price does. Straight up, intended direction, CME pattern, every single week.